צהריים טובים, תודה לכם על ההשתתפות במושב הזה, תודה טוביאס לבקוביץ, זאת לא הפעם הראשונה ולא האחרונה שלו בישראל, יש לו משפחה, הוא מבין עברית, אבל עדיין לא ברמה של לקיים את השיחה הזאת בעברית, אז באמת ברוך הבא.
תודה רבה.
וזאת נסיעה ארוכה מארצות הברית, כמובן שאנחנו מודים לך על ההשתתפות כאן. So I'll switch to English. So welcome, and basically what we would like to do is hold a brief Bloomberg type conversation about the outlook for markets, a very simple topic, right?
Very simple.
The outlook for markets for 2016. When we are ending a year that was quite disappointing, both from the point of view of the real economy, financial markets, commodities, you just name it, I think it's the Citibank view, the Poalim view, that things have been very disappointing. So, Tobias, we want to be forward-looking. It's much more interesting to entertain possibilities about the future as the global U.S. strategist, equity strategist for the U.S. By Citibank, two key factors that seem to have been the major surprises of the year, and correct me if I'm wrong, have been the price of oil and emerging markets. And both of them are related one to each other. So how do you see the price of oil looking forward? How do you see the state of China, Russia, Brazil, and other key emerging markets going forward?
Okay, so let's start with oil, because clearly it was one of the biggest disappointments last year, or this past year, in that people expected oil to be down, but they didn't expect oil to be down this much, and the earnings drag that brought it. So at this time last year, as an example, we thought the S&P 500 would earn $128.25. It's going to earn about $120, so clearly $8 plus shy. Probably 3/4 of that is just energy. Now, the good news is that energy has fallen 55% in earnings. It isn't going to do it again. And the only way you get there is if you believe there's a global recession and demand falls off. Everyone knows about the supply of shale projects in the U.S. Everybody knows that Iran is going to enter the market next year. And in that sense, it's too late. The Saudis don't want to pull back production. So the only thing that's going to happen to drive oil down would be demand falling off. That's not in our view. Edward Morris, who is our chief head of commodity research, is calling for $55 oil West Texas.
55.
55 for West Texas Intermediate.
By when?
By the end of next year.
Okay.
So this time a year from now. Mm-hmm. And if that's the case, then we should actually get a boost from earnings. We should get a boost from energy stocks as well. That would be a positive to some of the countries that you mentioned, but not enough. In the case of Brazil, they have political issues that they have to resolve, significant current account deficits, currency issues. So it's not a simple answer. Energy will help them. It would probably help some of the Middle Eastern countries. It would help countries like Canada, Australia, and then selectively in Norway. You'd find a few developed economies that would benefit from it as well. The emerging economy disappointment shouldn't have been as big a disappointment as it seems. The country, particularly China, that everyone focuses on, has been telling us for years that they were going to shift from an investment and export-led economy to one that was consumer and services oriented. And my view has always been that the guys who control the money, if they tell you they're going to do something, probably should listen to them, because they're the ones who are determining how that money is going to be spent. So I'm somewhat surprised that people have been that shocked by how EM has played out.
Good. As a very close follower of the U.S. economy, how do you see the U.S. economy 2016, 2017? How do you see different sectors, the labor market? And the key question that, of course, is one that worries the Fed: when are we going to see inflation picking up?
Sure.
defined that by the way the Fed looks at it, that by the PCE,
Right.
the consumer price deflator.
I only have 10 minutes to explain this, right?
Well,
So let's start off with
you
inflation.
have 3 minutes. We
3
have other
minutes, okay.
topics.
We have other questions, all right. So let's start with inflation. There was a discussion before about lowflation. This is kind of a very generically accepted view around the world, not just in the US. And the primary issue for inflation would have to be not in the data from energy, because that's non-core. It's transitory, to use the words of Stanley Fisher, a name that everybody in Israel knows well. Right now, the core CPI came in at 2%, the most recent data point, which is what the Fed wanted as kind of liftoff point for them. But the key factor is labor market. 60% of corporate cost in the country comes from people, only 10% comes from commodities. So that isn't where the sensitivity is. And we're starting to get a tighter labor force. We're seeing shortages in the workforce in areas for home builders. They will tell you they can't find plumbers, electricians, etc. And I keep telling my son, who wants to become a psychologist, that he should become a plumber. My wife's not happy with that, just so you know.
He can be a plumber in the morning and a psychologist in the evening.
Well, I think if it's better, the reason I tell him that, I think he'll make more money cleaning garbage out of people's toilets than out of their heads. But the concept of shortages in plumbers, carpenters, masons, electricians, machine tool workers, welders, pipe fitters. We're even hearing stories about, believe it or not, Hollywood doesn't have enough screenwriters or talented directors. So if anybody wants to change careers,
we have plenty of those in Israel.
There's shortages of these types of talent. And that usually means higher price for the talent. So we will probably see that coming in this year. And we expect that to hurt some of the corporate margins in the US this year as a result. The good news is companies are telling us that they still intend to hire, which is hugely important. The National Federation of Independent Business is a great, I'm not saying a great 12-month lead indicator for unemployment if you look at what the hiring intentions is of these small business people. And that's still very solid. Capital spending, where everybody's really worried about energy, it has improved from 11% of GDP back in 2009 to 13%. And despite the fact that the energy sector has collapsed, capital spending has stayed around 13% of GDP. So we're seeing technology growth, things like mobility, cloud, cybersecurity. Those things are still very powerful drivers for economic activity. And so if you put that all together and you say, hey, the US is doing okay. Are there potential shocks to the system? Obviously, geopolitics, the currency could be a problem, but it hasn't been quite the problem people thought it would be.
Okay. Let's turn to more quantitative sort of questions. What is your house view on the percentage gain in the S&P 500 from now until the end of 2016?
So we're looking, and I'll give you numbers first, and I'll back up the percentage changes. We're looking for the S&P 500 to close next year at 2,200. It's about 2,060 or so right now. So that would be up about 7%. And that would be equal to what we think earnings will grow. And that's probably the tightest fit you'll find in markets, that earnings grow, markets grow with it. The concerns that occur are coming from things like raising interest rates. And historically, when the Fed has raised rates, on average, the market keeps going for another 2 years. So we shouldn't see the peak yet. There's concerns that we're doing it later in the cycle now, the earnings won't be as good, but we just suffered through a pretty lousy earnings year of no growth, and we think we'll get some accelerated growth so markets can perform.
And what is the City House view on the Fed funds rate throughout the year and by the end of the year?
So the City House views, our economists think that we'll be at 1% by the end of next year, and that the 10-year Treasury yield will be 2.3% by the end of next year. The only issue I have with that latter one is we're already at 2.29% right now. So that seems like no movement is, I think, a little shakier.
Okay. In terms of equities, what would be the sectorial composition? We hear a lot of people, many analysts, coming with the idea that, well, maybe the story for 2016 will not be so much the broad indices, but rather the selectivity, long the good ones and short the bad ones, of course.
That's usually the way it works. Buy low, sell high.
Sure.
Not in my personal portfolio, but in the way it should be for others. If you look at the selectivity was actually even very important this past year. So for example, if you bought just to give you the consumer discretionary sector, you'd be up 11, 12%. And if you sold energy, you would have made another 25%. So that would have been a pretty good trade. Just having those two right would have made your year.
Sure.
So I think you're going to see more of that. I think it'll shift a little. Higher bond yields tend to be more positive for value stocks over growth stocks. So we may see a shift towards value, and that would include areas like financials and even energy, which is so deeply out of favor, and less about chasing healthcare and consumer discretionary, which has been the kind of trade people wanted to do this year.
Is this the time to jump into energy stocks, or you'd rather wait for a lower volatility and a bit of more tranquility in the market?
So the contrarian in me says, don't wait, jump in now. And I sometimes think it's a strict religious upbringing makes you want to be rebellious. But it's more about the valuations, and I'll be very clear about this. We look at which valuation metrics are predictive of stock prices. We don't look at which valuation metrics are cheap or expensive. That's an opinion that's subjective. Quantitatively, you can calculate when the PE is this, when the price to book is that, what do stock prices do, and you can go look back 20, 25 years of history. So right now, the valuations of particularly the integrated oil stocks and the oil equipment and services stocks are looking as if they're ready to really move and outperform. And that's the kind of thing I care about. The same thing shows up in banks and insurance, for example, within the US. So it's which valuation metrics tell you to buy. And give you one last clarification for the listeners. I used to cover machinery companies like Caterpillar, John Deere, as an analyst for 15 years. You always wanted to buy these stocks when they had very high P's, and you wanted to sell them when they had very low P's. And the reason was, when they had low P's, the market was already telling you that earnings in the future were going to go down. You were at a cyclical peak. And when you're at high P's, they were telling you that the earnings were going to start to pick up again. So if you think about energy that way, many of them are trading at high P's and would indicate that the stock prices are more attractive.
Sure. In terms of a more global approach, we hear many investment houses sort of reiterating the sort of recommendation that we had for the year that is ending. In other words, go for stocks in Europe and Japan, and maybe a little less weight to the US. And now with the depreciation of the euro and the Japanese and the situation in Japan, it may be that some companies are looking much, much better than in the past. What is, again, the Citi house view on this global allocation of the portfolio of equities?
So Citi's house view is very similar. We tend to favor Europe, ex-UK, and Japan because of quantitative easing policies in those countries, that they'll continue to push the monetary policy and drive economic growth if they have to. And we've heard Mr. Draghi, say pretty much once again, do whatever it takes. So we have that view on hand. I think it is pretty consensus, which makes me always a little uncomfortable. We're neutral to the U.S. We're not negative to the U.S. as a global house. Robert Buckland, our global strategist, would tell you that. In emerging markets, we tend to have more of a North Asia versus South Asia focus. And again, we talked a little bit about Brazil's unique issues, why we're not that excited about Latin America. To come back to one other aspect, though, this idea of the currency devaluation making companies competitive, that's probably a little less true today than it used to be because of global sourcing. And again, I used to cover industrial companies. When we had $1 at 250 yen, moved to 120 yen in the 80s, this was a huge issue, and it changed the way businesses thought about sourcing around the world. With the internet today, you can source anywhere in the world. And it's not as significant other than translation effects. So you'll translate back the overseas profits at a better rate based on currency, but it doesn't really change the competitive dynamic the way people would expect.
Thanks very much. So I get all kind of signals that we should conclude. So just for the benefit of the audience, if you don't mind, I will summarize in Hebrew in 2 sentences what I guess is the kind of consensus, because basically our views at Poalim and Poalim Asset Management in London are very similar to yours.
I may have to rethink my entire view now.
אז המסר, אני חושב שהשורה התחתונה מהמושב הזה הוא שעם כל הצניעות שמתבקשת אחרי שנה שהרבה מאוד תחזיות שלנו, כלכלנים ואנליסטים, באמת לא קלעו וטעו בגדול, סביר מאוד להניח, נכון לרגע זה, ש-2016 תהיה שנה טובה יותר מ-2015. ב-2015 היו שני זעזועים שליליים, ההאטה בסין, ההאטה במתעוררים, מחירי הנפט שירדו בצורה דרמטית, מספיק שזעזועים בעוצמות האלה, בגודל הזה, בחשיבות הזאת, לא מתרחשים כל שנה. אז אם נקווה ואם נחזה שהדברים מתחילים להתכנס לאנשהו, גם בתחום של מחירי הנפט וגם בתחום של השווקים המתעוררים, אז כבר מזה ובעולם של ריביות נמוכות והרבה מאוד נזילות מתבקשת המסקנה שככל הנראה 2016 תהיה קצת יותר טובה מ-2015, נקווה שתהיה הרבה יותר טובה, ועם המסר המעט אופטימי הזה אנחנו נסיים ונודה לאורח. תודה רבה.